All right, let's dive into Gap Inc.'s second quarter earnings for 2025. And wow, this report, it was a real head-scratcher, telling two totally different stories at the same time. So let's get into it and unpack what really happened.
So here is the central puzzle, right? Gap actually beat profit expectations. They did better than Wall Street thought they would. So why on earth did the stock initially just plummet, dropping 10% in after-hours trading? It just doesn't make any sense on the surface. To figure this out, we've got to dig into the story behind the numbers.
Okay, first things first. Let's look at the top-line results, because this is where all that confusion really started. And honestly, at first glance, things look pretty solid. So the big number everyone always looks at is earnings per share, or EPS. They hit 57 cents, which was a beat. That's good news. Revenue is basically right in line with what everyone expected, so fine. Gross margin did dip a bit, but management was all over this, framing the quarter as over-delivering on profit expectations. So everything's looking great, or is it?
Well, yeah, not so fast. The market's reaction was just pure whiplash. At first, you see these headlines about margins and new tariffs, and boom, the stock tanks, down as much as 10%. But then, get this, by the next day's close, it completely reverses course, ending up in the green on huge volume. So what in the world happened to cause that massive swing?
To really get that reversal, you have to stop looking at Gap as just one big company. You have to see it for what it is, a portfolio of 4 very distinct brands. And believe me, each one is telling its own, very different story this quarter.
And let's just talk scale for a second here. Old Navy is the 800-pound gorilla in the room. We're talking $2.2 billion in sales. It is the absolute engine of this company, no question. How Old Navy goes is pretty much how the whole company goes. Okay, and this is where it gets really interesting. You've got Old Navy, Gap, and Banana Republic all growing. All of them posting positive comparable sales. That's fantastic. But then there's Athleta, down a staggering 9%. It's not just an outlier, it's a massive anchor dragging down the overall results.
Now, despite Athleta's struggles, you had the CEO, Richard Dixon, on the call sounding super confident. He's talking about their reinvigoration playbook and how it's working. And you know what? For 3 of the 4 brands, he's absolutely right. The core business is showing some real momentum. I mean, the Gap brand itself, that's 7 straight quarters of growth. That's legit.
So what do you do with a problem like Athleta? Well, management is basically hitting the big red reset button. They're calling 2025 a purposeful reset year. They straight up admitted, hey, we got the product mix wrong, and that's why they had to discount everything so heavily. Their big move? Bringing in a new president and CEO, Maggie Gower, a veteran from Nike, to completely overhaul the brand. It is a classic turnaround play.
But hold on, this story isn't just about what's happening inside Gap's 4 walls. To understand why the market freaked out at first, we need to talk about a huge storm cloud gathering outside the company, and that is tariffs.
Yeah, this number right here is what spooked investors. Management is estimating that new trade policies are going to hit their full-year operating margin for somewhere between $150 and $175 million. That's not some vague worry. That is a direct, quantifiable hit to their profitability.
But to their credit, management isn't just sitting back and taking the hit. They laid out a very clear 3-part plan to fight back. The biggest piece is an aggressive shift in their supply chain to get out of China, aiming for less than 3% exposure by the end of next year. Alongside that, they're tweaking products and carefully raising prices where they think they can.
And this quote from the CFO, Katrina O'Connell, really puts a fine point on it. What she's essentially telling the market is, look, if you strip out this external tariff problem, our core business is so healthy that our margins would actually be growing. Now that's a powerful message, and it's probably what helped the stock stabilize.
And you can see all of this coming together right here in their updated forecast for the year. They held their sales guidance steady, which is a sign of confidence. But the operating margin? Yeah, it took a significant cut, a direct result of those tariff headwinds we just discussed. So let's put it all together. You've got the strong core brands on one side, but a troubled Athleta and major tariff pressure on the other. What's the final verdict when you weigh all that? Well, here's our take looking ahead.
We're slapping a market perform rating on this for the next quarter. Look, there's a lot to like about how they're running the core business, but that combination of external tariff pressure and the drag from Athleta, it keeps us from being outright bullish.
And here's the thinking. The positives are clear. The playbook is working for 3 out of 4 brands. Simple as that. On the neutral front, the Athleta turnaround has potential, for sure, but it is a total show-me story. We need to see results, not just plans. And the negatives? Well, those tariffs are going to hurt margins, and a 9% rise in inventory is definitely something to keep an eye on.
So looking ahead to Q3, we're watching a few key things. Can they actually hit that sales forecast? Are we going to see any, and I mean any, early signs of life at Athleta under its new CEO? We'll also want to hear updates on their tariff plan. A little thing to watch is their Better in Denim campaign. If that sells well, it's a great sign. But really, it all boils down to one question. Can the strength of Old Navy, Gap, and Banana Republic continue to carry the weight of both the tariffs and the costly reset at Athleta? The answer to that is going to decide where this stock goes next.
All right, that's our breakdown. And just a reminder, this is for informational purposes only and does not constitute financial advice.